Your hand freezes at the closing table. $300,000, 30 years of payments, a stack of papers you barely understand. At some point, it stopped feeling like a house and started feeling like a life sentence. Here's what almost nobody sees in that moment. That 30-year fixed mortgage, the thing you're afraid of, is built on terms even Wall Street can't replicate to buy stocks. A rate locked for 3 decades, no penalty to pay it off early, and a lender who can't take it back when the market turns. The house is what you live in, the loan is the prize, and once you see what inflation does to it, the scariest paper at the table becomes the best deal you'll ever sign. Try something. Walk into a bank tomorrow and ask to borrow $300,000 for 30 years at a rate that can never go up, that you can pay off early with no penalty, and tell them you want to buy stocks with it. Watch their face. To start a business? No. A car loan runs 5-6 years around 7%. A credit card, you're looking at 21% the bank can reset whenever it feels like it. There is exactly one thing on earth a lender hands you that deal for. A house. 30 years, fixed, prepayable. Today, about 6.48%. Sit with how strange that is. The most sophisticated investors alive, hedge funds, billionaires, people with armies of lawyers, can borrow plenty, but not like this. Not a 30-year fixed loan on their stocks that the lender can never call. The best they get is a floating rate the bank can yank back anytime. They'd line up around the block for the loan sitting in a regular homebuyers folder, on terms most professional investors can't replicate in one clean retail instrument. You can. So why? Why is the mortgage the one place the system hands an ordinary person terms this good? Hold that question. We're coming back to it, and the honest answer is darker than the loan looks. First, let me show you what you're actually holding. The median home in America right now runs about $429,000. Put 20% down, you're borrowing around $343,000. At 6.48% on a 30-year fixed, the principal and interest, the loan part, the part that actually pays down the house, comes to about $2,166 a month. Now picture the move the mortgage math channels pull. They line up all 360 of those payments, add them into one terrifying total, and flash it on screen. Look how much interest you paid. The number is real. It's also the wrong number, because it's a nominal number. Here's the sleight of hand, and most of them don't even know they're doing it. They take $1 you'll pay in year 28 and set it down right next to $1 you pay today like they're twins. They're not. 3 decades of inflation got to that year $28 first. Inflation, that's the word that cracks this whole thing open. It just means prices drift up and your dollar slowly buys less. Long term, inflation runs about 3% a year. We feel it as a tax. The same cart of groceries that's $100 today is $103 next year, and we hate it. But watch what that does to a fixed payment. Picture the check you write the bank. Year 1, it says $2,166. Year 30, the very last month, it still says $2,166. Same number, same ink, it never moves. Now, picture what that exact same $2,166 can buy over those 30 years and watch the cart shrink. 10 years in, that payment is worth about $1,612 in today's groceries. 20 years in, about $1,199. The final year, around $892. Same check to the bank, less than half the cart. You froze the number while the world got more expensive around it. And here's the other blade of the scissors. Over those same years, your paycheck tends to rise. Partly real raises, partly because wages drift up on the same inflation tide. Day 1, the payment eats about a third of an $80,000 income. If your pay just keeps pace with inflation, by year 30, that same payment takes about an eighth of your check. You did nothing heroic. You set up an autopay and lived your life. And the most expensive thing you own got quietly cheaper every single year from both ends at once. That's the engine. Write this one down because it's what you carry out of here. A fixed-rate mortgage is a short position on the dollar. Let me translate because that's Wall Street talk and I promised to explain everything. Short, the dollar means exactly this. You borrowed a pile of dollars today and you pay it back over 30 years in dollars worth less and less. The dollar weakening is the whole point. It's working for you, not against you. That's what being short something is. You win when it loses value. The exact force that quietly robs every saver on earth is, for you, working the other way. It's on your side of the table. And here's what almost nobody maps out. Inflation is the feature you feel first, but it's only one of 5. Start with leverage. Put as little as 5% down and you control the whole house, roughly 20 to 1. Try that with stocks and ordinary margin rules. Cap the broker loan near half the purchase price, closer to 2 to 1. Then there's the protection. A stock portfolio is marked to market every day. Fall far enough and the broker can force a sale. No notice required. Your mortgage payment isn't marked to market. If the home's value drops, the payment doesn't move, and the lender can't call the loan just because the market did, as long as you keep it current. So count the instrument. High leverage, a rate fixed for 30 years, a payment no margin call can touch, no forced sale while you're current, and inflation melting that payment a little more every year. 4 of those are the frame. Being short the dollar is the engine. Now I have to be straight with you, because a fair objection is building. That $2,166 is not your whole housing bill. There's property tax, there's insurance, there's the roof that eventually leaks on a $429,000 house, call it another $900 a month. So your real carry starts closer to $3,050. And those pieces are not frozen. They ride the inflation escalator up with everything else. But sit with what that actually means, because it doesn't dent the point. It sharpens it. The biggest single piece of your housing cost, the $2,166, the part that would otherwise be rent for the rest of your life, that is the piece you bolted to the floor for 30 years while the world's prices walked right past it. Nobody escapes inflation. You just moved your single largest expense onto the one side of it where inflation loses. So go back to my question, the dark answer I owe you. Every trade has another side. When you win on the slow erosion of money, someone loses on it. So who lent you this? Not really the bank. It usually sells your loan within weeks. Your mortgage gets bundled and sold to a pension fund, an insurance company, a retiree's bond fund. And here's what happens to them. They hand over real, valuable dollars today, and they get back a fixed trickle of dollars that inflation shaves a little thinner every year for 3 decades. They are long the dollar. You are short it. On a long enough timeline, you are quietly, politely pulling value out of them. They already priced in some inflation. It's baked into your rate. You win on the part they didn't see coming. And over 30 years, it usually runs hotter than anyone bet. And now the genuinely uncomfortable part. This isn't an accident the bank failed to notice. The 30-year fixed prepayable mortgage barely exists anywhere else on the planet. It exists here because the government built the machinery to make it exist. Institutions that buy, guarantee, and securitize these loans at enormous scale, specifically so lenders will keep writing them. Somebody decided, as a matter of policy, that ordinary people should be handed one of the few ways a regular person ever gets fixed-rate, long-term leverage on an asset that tends to rise with inflation. The losing side often sits with whoever holds the mortgage bonds, pension funds, insurance portfolios, bond funds, and retirees indirectly through them, collecting a fixed coupon that inflation chips away at. That's the trade. It's legal, it's consensual, it's enormous, and almost nobody buying a house realizes which seat they've been handed. Let that recolor the fear you walked in with. At that table, you thought you were the small, scared party, signing 30 years away to an institution with all the power. You had the seats reversed. You were being handed the better side of a deal the system built on purpose, and you were terrified of it. And it tilts further your way because of one word I keep repeating: prepayable. If inflation runs hot and rates climb, you sit still and your frozen 6.48% loan gets more valuable, since everyone borrowing after you pays more. If rates fall, you refinance lower, no penalty. You keep the win when inflation helps you, and you get a clean exit when it doesn't. Heads you win, tails you barely lose. Finance has a name for a deal where you keep the good outcome and walk from the bad one. It's called an option. And options are never free. You're paying for it. It's baked into your rate. But it's the rare option an ordinary borrower can buy at all. And most people never notice they own it. So, am I telling you debt is good now? No, I'm telling you one specific kind is. Credit card debt at 21% is a short position too, except the bank is shorting you and that balance compounds against you faster than inflation could ever dig you out. Fixed, long, prepayable, tied it to something that holds value. That's the rare flip where the math runs your way. Break any one of those and the magic dies, which is exactly how this asset turns on you, and I'm not going to skip that part because then I'm just another guy yelling, buy a house. So here's the live test. 3 things have to be true, and you can check all 3 before you fall in love with any kitchen. The rate has to be fixed, really fixed. An adjustable rate mortgage resets after a few years, and the day it resets, you've handed the bet back. Now the payment can chase inflation right up and catch you. Picture year 5. Rates jumped, your fixed payment wasn't, and the bill is suddenly $400 heavier than the life you built around it. The frozen payment is the asset. Don't trade it away to shave half a point off the starting rate. You have to stay long enough. Shorting the dollar is a marathon. The real value only compounds over a decade plus. Sell in 3 or 4 years and the buying and selling costs eat the edge before inflation does a day of work for you. And the payment has to be one you can actually carry, which is the one that decides everything, because it's not about the loan at all. It's about you. So, 2 people and one of them is you. Say you're single, renting, around $80,000, sharp with money, and every time you run a normal house, the numbers feel off. They are off. That $3,050 carry is about 46% of your gross. And the old rule, a good one, says total housing should sit near 28%. 46 is not 28. Your gut was right. On one $80,000 income, the median home is a genuine stretch, and no amount of inflation magic saves a payment you can't make in year 1. Now say you're a household. 2 incomes, around $130,000. Same $3,050 carry is about 28% of gross. You land right on the line. Same house, same loan, completely different trade, because the asset only pays the person who can hold it. And here's the trap. Whichever person you are, you stretch. You buy a little too much house because the lender approved you for it, and lenders will waive you well past that 28% line. You tell yourself the raises will come. Year 1, no raises. The water heater dies in February. The insurance bill jumps, and the payment is eating nearly half your income. You're not enjoying the slow, beautiful erosion. You're drowning in month 4, and inflation's 30-year gift means nothing because you won't be there in 30 years to collect it. So here's the hard line you can use tomorrow. Keep your total monthly housing cost, loan, taxes, insurance, upkeep, all of it, at or under 28% of your gross pay. Buy at that number, not the one the lender dangles. That's not me being timid. That's me making sure you live long enough to win the trade. Now, let me settle the fight everyone has, rent versus buy. Honestly, because the buy now crowd cheats. The cheat is racing your frozen $2,166 against rent and leaving out the other $900. So let's race your whole carry, taxes and insurance and upkeep included, and plot both lines for real. For a simple national scenario, say renting the same place starts around $2,000 a month. Your owner's carry starts at about $3,050. Read that again. On day 1, owning costs about $1,050 a month more. That's real, and most channels hide it. Now run 30 years at 3% inflation on both. Rent is all escalator, nothing frozen, about $3,600 in 20 years, $4,850 in 30, climbing the whole way. Your owner's carry climbs too, but slower because its biggest chunk won't budge. About $3,800 in year 20, $4,350 in year 30. So watch the 2 lines. For the first 20 plus years, the owner's line sits above the renter's. You pay more month after month, no spin. But the gap narrows every year because the rent escalator never rests while your frozen core drags your line down. Somewhere around year 23, the lines cross. After that, the renter pays more, and the gap just keeps widening in your favor. And that's before counting that every owner payment was quietly buying you equity instead of buying someone else's. The only reason the lines ever cross is the freeze. Kill it, go adjustable or rent forever, and they never meet. Your cost just chases inflation up the wall for the rest of your life. None of this means buy instead of rent. Buying a home is a lifestyle decision first. If you might move inside 5 years, the math favors renting, full stop. The point is narrower. If you're going to buy and stay, the thing doing the financial work is the frozen financing, not the house. So the old fight was mislabeled the whole time. The renting is throwing money away crowd is right that rent never stops, but they think the prize is equity. The house is a terrible investment crowd is right that the building appreciates slowly, but they're measuring the building. Both are staring at the wrong object. The story was never the house going up. It was your biggest payment refusing to. One line before the how-to. This is financial education, not personal financial advice. Run these numbers against your own situation, not a stranger's. So here's what to actually do this week. Stop shopping a home like an appreciating object. Shop the financing like the instrument it is. The countertops are negotiable. The terms are the asset. 1. Run the 28% number before you open a single listing. Gross monthly pay times 0.28. That's your all-in ceiling, everything included. That number decides what house you get to want, not the lender's approval. 2. On a single day, get a written loan estimate from 3 lenders, a bank, a credit union, an online shop, each on a 30-year fixed. Same day, because rates move daily, and same day is the only honest comparison. 3. Compare them on one number, and it's not the interest rate. It's the APR. The plain rate is just the interest. The APR folds the fees and points in too, so it's the true cost of the loan. A low rate with fat fees can lose to a slightly higher rate with none, and the APR is where that shows up. Lowest APR on the same fixed term wins. 4. Before you sign, confirm 2 words are on the page. Fixed and no prepayment penalty. Those are the asset. Everything else is decoration. One last trap the math channels will throw at you. A 15-year fixed comes with a lower rate around 5.79% today. Cheaper, right? Sometimes. But you're locking a bigger frozen payment and buying fewer years of inflation working for you. The lower rate is a real discount. The shorter runway is a real cost. There's no universal winner. Weigh the trade instead of chasing the smaller number. And if you already own at a low fixed rate, you're holding a genuinely valuable position. Don't reflexively throw money at it. But whether to pay a mortgage off early isn't just a math problem. It's a liquidity, job security, risk tolerance, and peace of mind problem. And it gets its own video. For now, don't kill a low fixed rate just to feel debt-free. And don't keep it if carrying it is costing you sleep. If this flipped something, if you walked in thinking the house was the asset and you're leaving knowing it was the loan all along, that's the whole reason this channel exists. We find the spot where conventional wisdom is careless and show you the frame underneath. So subscribe, because the next one is the question this video forces. If a fixed mortgage is the asset, should you ever pay it off early? Or is that the most expensive feeling in personal finance? And do me one favor in the comments. Find your payment or the rent you pay right now. And tell me what that exact number will feel like in 20 years after inflation has had its way with it. One's mostly frozen, and one climbs. I want you to see which one you're holding. The house is still where you live, and that part was never in question. What you didn't see is that the loan is the piece doing the financial work. Because money is a tool, and the best one you'll ever be handed showed up disguised as the scariest promise you ever made. I'm Cole. This is the Money Professor.